So when a community is embarking on a capital project, they really have three options to pay for it. Number one is to just pay out of operating funds. So if you have an association that has a lot of money and they can just foot the bill straight up, that's one option. The second is to special assess and pass an assessment so that over time the owners can make payments and finance the cost of the project. The third option is to secure a loan. So a loan will require a special assessment, but what a loan allows you to do is to pay a lot of money up front for the project and then have the owners make payments over time to pay back the loan. An association will take out a loan for a capital project when the cost of that project is far too great to ask owners to pay up front. So I have two best practices for special assessments and capital projects. The first is to over-communicate. My association is in the midst of a special assessment. My board's done a really nice job of communicating in every board meeting. We've had town halls that are very specific to the project. It's in every written communication we have, newsletters, weekly updates from the manager. And I'm often surprised to hear that some of our owners still are questioning what's going on. So if you think you've communicated enough, I recommend doing it a little bit more. And at least you have those resources where you can point your owners who say, I don't know anything about what's going on, because there will be those. The second one is transparency on the project. So it may get a little boring and mundane to go through the numbers every single board meeting, but I think it's very good practice. Walking through what the financial aspect of the project looks like, what the physical progress of the activity is, and the accounting on the special assessment, and documenting that in the minutes, again, to answer questions for owners who may not participate in those meetings and say they don't know what's going on. Anytime an association secures a loan, you're telling the bank and the membership what that loan is for, and that includes an emergency line of credit. An emergency line of credit is for just that, emergencies. So I wouldn't look at an emergency line of credit as a source of funds for a capital project. Instead, you want to go back to the bank and say, we are undertaking a capital project, and here are our sources and uses of the funds that we're asking for, and secure a loan for that capital project itself. Since a planned capital project is really outside of the scope of how an association operates day to day, you really want to let your insurance agent and insurance companies know what you're undertaking to make sure that you have all of the necessary insurance to cover it. You want them to be the ones to tell you if you need to buy something else or not. They're your partners, they're your experts, right? So association insurance is really built to cover an association operating normally on a day-to-day basis. And if you're undertaking a very large-scale project, you need your insurers to point out what you have, what you need, and where any gaps are. If the project you're undertaking is outlined in your reserve study, you can absolutely spend your reserve funds on those items. If you're undertaking a project and you have not reserved for it, then you're going to need to find another source of funds, whether that be special assessment or a loan. Reserves are really dedicated funds, as outlined in the reserve study, for specific items as required by statute.